Hi, Steve Clapham again, and I'm here to talk to you about accounting red flags. We're going to go through a whole series of videos looking at these red flags. And the first one, our red flag detection tool number one, is read the audit report. This is particularly important in the case of Thomas Cook, the failed package tour operator. If you'd read the audit report, not only would you saved yourself a lot of money if you'd invested in the business, but if you were a customer, you probably wouldn't have gone on holiday with them. Because in the Thomas Cook Auditor's Review, with its interim results in 2019, the auditor expressed a doubt about going concern. And if you see the words going concern in the audit report, and there's some negative connotation around it, what it means is that the auditor is worried that the business can't continue as is. It can't continue as a going concern. And if you see that, there's a risk that the company could go bust. And the auditor won't flag that as an issue unless there is something fundamental about it. So that is a key thing to look for. What else should you look for in the audit report? Look at the auditor identity. If it's not one of the big four audit firms, then ask yourself why. In the UK, there's 5 big audit firms that audit the FTSE 350. But if you've got a very small firm auditing a very large company, ask yourself, well, would they have the ability, would they have the resources to satisfactorily conduct an audit of this kind in a company that may be quite complex, for example? The auditor location also used to be a good signal because we've had a whole string of frauds in the UK, and many of them were audited by a regional office in the Big Four. And the regional offices were more susceptible to having the wool pulled over their eyes. All of the Big Four firms now have technical centres of excellence in London, and the regional offices are now required to ask for help from London if there's something complicated. So this is less likely to be an issue going forward. And you need to read the audit report. You do need to read it, and you need to read the comments the auditor makes. The debates with management on the way the accounts have been constructed, the assumptions that management has made, tell you a lot about the business. It's like the auditor shining a spotlight on the areas of greatest sensitivity. So read the audit report. It won't take you long. Carillion, the auditors received a lot of criticism, but they had a boilerplate paragraph in here about the issues on recognition of revenue. I mean, if you'd read that, you would have been aware that there was a risk. And audit fees. We have a whole series of checks that we do where we look at the fee versus history, the fee versus sales, the fee versus peers, and the fee versus non-audit fees. That's quite difficult to do all of those things if you're a private investor, but you can check the non-audit fees. And the non-audit fees should be low in relation to the audit fees. And you can see here that the vast majority of companies, both in the EU and in the US, have an audit fee which is less, a non-audit fee, which is less than 30% of the audit fee. If it starts to get more than that, you should ask a question. Is there anything else that I feel uncomfortable about? So that's it on audit fees and on audit reports. Make sure you read the audit report and you check the audit fee in the next company you invest in. Thanks for watching.